அனைவருக்கும் வணக்கம். ஓகே, குட் மார்னிங் எவ்ரிவன். ஓகே, நான் பேசுற ஆடியோ கேக்குதுங்களா? We can wait for another 5 more minutes so we can start our session. Okay, the session will start in another 1 minute, so we can wait for all the people to get joined in the session. This session is what little bit advanced when you compare with our previous sessions. Okay, here the option trading workshop. Today we are going to discuss much more advanced topics in this in the webinar. Like actually we have the straddles, PCRs, and we have the strategies we are going to talk about in this webinar. So first of all, we have to know what are the indices that is currently trading in India. Okay, the first is the Nifty 50 and is a Bank Nifty. Then third is the Fin Nifty, and fourth we have the Mid Cap Nifty. Mid Cap Nifty actually that has started like about 2-3 months back. It got the volumes have started building up. The primarily we are trading the Nifty, second is the Bank Nifty, and third is the Fin Nifty. Okay. Okay, from the basic, so we can see Nifty. So lot size is the 50. We can see the number of scripts in the Nifty is 50. We can see the weightage. Okay, what are the major weightage in this Nifty is a Reliance, then the HDFC Bank, and the ICICI. Okay, this three comprises 30% of the Nifty index. Okay, so when is the weekly expiry? That is on a Thursday. Okay, we can go to Bank Nifty. So current lot size for the Bank Nifty is 15. Okay, because of the price. Okay, the Bank Nifty lot size from 40 they reduced to 25. Then now it's a 15. Okay, so number of script in the Bank Nifty is 12. So with this one we can see the weightage. Only the we can see only the two scripts, HDFC and ICICI, that is comprising 55% of the Bank Nifty. Okay. It means that if the both HDFC and ICICI, if both is positive, then Bank Nifty will be positive. If both is negative, then the Bank Nifty also will come to negative. Then the third is the Fin Nifty. Okay. So here we can see the lot size is 40 and number of script is 20. Okay. Here also we can see this two scripts, that is HDFC and ICICI, having the higher weightage, that is the 40%. So expiry is on every week is the expiry is there. That's on a Thursday. Then fourth is the Mid Cap Nifty. So lot size is 75 and number of script is 25. We can see these four scripts. There is a Shriram Finance and Shriram Financial Bank and Federal Bank. Okay. So this three comprises the top weightage, and we can see expiry is on Monday. Because from Tuesday they change it to Monday. Oh, sorry, that's from actually Wednesday they change it to the Monday. Okay. So here what we are going to discuss on this webinar. Okay. The first is the PCR, and second is the straddle. Okay. And third is the straddle breakout, and the short covering rally, and fourth is the gamma blast. Okay. So what is the gamma blast 350? Okay. And fifth is the Batman strategy, right? And fourth is the calendar spread. So with this one, we are going to discuss one more additional strategy, that is for intraday. Okay. Okay. See, we can see the market is controlled by sellers, right? Because being as an option trader, 95% of the people, they do what you call option buy and option sells. Okay. Within this, because they won't hedge it with the equity, they do the option trading directly. When you compare the overall market, right? Overall the what you call this NSE and BSE, when you see 95% of the trader, they do option tradings. Okay. So in the option trading, okay, we can see option sellers are dominating the market. So that's why we can see the premium in the Friday, it will be 250 rupees. The Monday, it will be 150, and Tuesday, and we can say Wednesday, premium will just decay as much faster. Okay. So that's why we have to see it from a seller point of view. Okay. How he is trading. Because actually indicators that will give a momentum. Okay. But we should know the trend. What is the exact trend of the market? Okay. Okay. To see the trend, from the seller point of view, so we have the PCR. The number one is the PCR, and second is the OA buildup. Okay. And third is the maximum pain. So first we can see the PCR. Okay. So PCR is very simple. That is a put call ratio. So we know about call and put, right? The call is means that the people buy the call, hoping that the market will go high. Okay. The people will buy put, hoping that market will fall, so they can make profit. Okay. Suppose if the we can see 44,000 strike price. Okay. In Bank Nifty, suppose if the people are buying at a large quantity. Okay. There we can see the OA buildup is very high. Okay, I will show from the NSE website. Okay, just a minute. Okay, see here. So I'm sharing this NSE India website. Okay, the chat section is open. Are the people able to see my screen? Okay, do the screen is visible? Okay. Okay, see here. So this is going directly to the NSE India website. So we can see here in the option chain. I'll share you the link. This is a direct link to see the options. Okay, see here. So here we have in the top we have a Nifty and Fin Nifty and we have Bank Nifty and the Midcap Nifty. So I am selecting the Bank Nifty option. Okay. The left side, what you see, these all are the call options. Left side. Okay. In the right side of my screen, this is the put options. Okay. We can see the white area here. Okay. This white area and this white area is the OTM strikes. OTM strike means out of the money options. And we can see this gray area. Okay. So they are the ITM options. That the in the money options. Okay. So here we can see the PCR. How we can define the PCR? Okay. Just scroll down. So here you have the bottom OA, right, sir? In the first option is the OA. That is the we can see that is the open interest. Okay. How many people have brought and sold at the particular time? Suppose if the one person buy one strike and another person sell at the same strike means then the open interest will be 1. Okay, it's clear. Suppose here we can see 44,400 option. Suppose if I am buying the 44,400 one lot, if another person selling the 44,000 one lot, okay, it means that I am a buyer. We have one more seller. This buyer and seller matches, and we have the one open interest. Okay. With this one, we can see if it is a 75,000, it means that 75,000 buyers and 75,000 sellers are in the particular script. It means that is the open portion, right? We can't exactly predict this many sellers and this many buyers, but we can say this is the outstanding number of lots. Okay, but we can say it is as like that. There are 75,000 70,000 buy and 70,000 sell. Okay. Okay, in the bottom, we have the total open interest for the call. And we have in the bottom, there's a right hand side. Okay, we can see there's a total open interest for the put option. So what we have to do, okay, to find the PCR, first we have to take this open interest, okay, put side open interest divided by the call side open interest. Okay, we can see there is a 24 lakhs here, and we can see here is a 21 lakhs. So just we can take the calculator and we can see there's a 2887,825 divided by 2139,802. So we have the 1.16. Okay. Okay. The put side is 2487,825. I'm just writing down. So this is a put side. OA. So then we have to see the call side open interest also. The call side OA. How much? So that is a 21 lakhs. So just we have to divide the put OA divided by the call OA. Okay. It will give you one value, right? Okay. So that value is the PCR. Okay. Put call ratio. If it is above 1, okay, if you are just dividing these two values, if you are getting value above 1, it means that market sentiment is bullish. If it is below 1, then the market sentiment is bearish. Okay, up to this is clear. The PCR above 1 is bullish, PCR below 1. If you are getting the value above 1 is bullish. If you are getting the value below 1, that is a bearish. So that is a market sentiment. So here what we are going to do, we just analyzing the seller point of view and finding the trend. With the trend, we are going to build the positions. Okay, at last we want to make profit in the market, right? So if we don't know how to see the exact trend in the market, we can't make money. Okay, if you want to make money, we have to see it from the how the sellers are operating the market. From that point of view, we have to build a position. Simply by seeing the chart alone, it won't work out. Okay, the chart is for a momentum price, right? If you're just confirming this all, and after that, if you're seeing the chart, then you get a clear idea, right? So first tool, what the sellers are using is there's a PCR. Okay. So here, next, what we are going to see, that's the OA buildup. Okay, PCR understood. Everyone understood? So PCR is there's a put call ratio. So the put open interest divided by the call open interest, it will give a value. Okay, it will give a ratio. It will be 1 or below 1. It will be above 1, right? Above 1 is bullish. So just keep it in the mind. Above 1 is bullish. Below 1 is bearish. Okay, with that one, we have one more secret. They're just keeping it. There's a rising PCR and the falling PCR. Say, for example, the PCR is below 1. Okay, say 0.5. But because the rising PCR and the falling PCR, we have to see it for intraday. Okay, not for positionals. And just the rising PR, that is for intraday trading. Suppose if you're doing intraday positions, we have to see the rising PCR or the falling PCR. How to find? If suppose if the morning 9:30 you have taken a position, okay, if the PCR is keep on rising, it means that what? The market is changing to bullish. If the PCR is continuously falling, right, it means that market sentiment is changing to bearish. Always we have to confirm with the price action. Okay. So the first tool is the PCR. Okay. So normally when you are carrying the positions, we have to see this PCR, then only you have to carry the position. First point. Okay. Second point, suppose if you are doing a intraday trading, okay, first you have to see the market sentiment. Okay. Then you have to find the ATM straddle PCR. Okay. So then comes what is the straddle. Okay. So straddle means, suppose if you see here, in the left side is call, and we see the right side is the put, and in the center we can see strikes. Okay, so I'm changing to this one. I'm sharing the NS website. Okay, see here. So in the center we have the strikes. Okay, so here we can see there's a 44,400 strike price. Okay, if a person buys one call option and buys one put option, okay, it means that he has entered into a long straddle. So it means that he is buying both the call and put. Okay, either he can buy the call and put, or he can sell the call and put. Okay. Okay. In which case, what they will do? Suppose if you can see, next year there is election. Okay, everybody will know, right? There will be some huge rally will be in the upside or in the downside. Okay, suppose if the Modi government wins, market will rally another. Where it will be 4,000 to 10,000 point, it can rally, right? So this is a hope. Okay, so what the people will do? So they will buy both the call and put, long straddle. Okay, only on the huge market volatility conditions, what they will do? They will buy the both call and put, hoping that they'll get a huge profit. Okay, rest of the case, what they will do? They will sell the call and put. Okay, 90% of the options. Okay, all the we can say all the OTMs, okay, ITMs, all the strikes will have the premium decay, huge premium decay. Suppose if you can see, when you have the total straddle, if it is a 3,000, okay, in the next week when you compare all the 3,000, the total straddle premium will just go to How much? 500 or at most what you call 1000. So who is capitalizing all this money? Sellers are capitalizing all this money. Okay. So the straddle is the combined the call and put. If you're buying the call and put, it is a long straddle. If you're selling the call and put, that is the short straddle. Okay, see your bank nifty. So we can see each and every strike price. In the left side, we have the call price, and in the right side, we have the put price. Okay. Say for example, the 44,400. This is the ATM straddle because what is ATM, right? The bank nifty is currently trading 44,436. So our straddle, our ATM straddle, at the money straddle will be 44,400. Okay. This two, right? So what the seller will do, say for example, if I'm selling this option, okay, how much price it has appreciated? Only 86 rupees. But how much price it has fallen? There's a 222 rupees it has fallen. Okay, so because the sellers are making huge amount of money by shorting the whole what this option strikes. Okay, so here next comes that is the build-up, that is the OA build-up. So here the OA build-up is the open interest. Okay, from the beginning I have shown you, right? The first column is the OA. Okay, OA is the, suppose if a person buys one lot, okay, and if a person sells one lot, then the OA value is 1. Okay, so likewise we can see from this page each and every strikes having the OA. Call side also we have OA, and the put side also having the OA. Okay, from the seller's point of view, what they will think, if there is a huge amount of OA buildup, that side, okay, that side is their favor, they will take much more sell trades. The first what we have find, we just taken the total OA of the call and put, and we are divided, and we got a value. Okay, that is a 1.16, that is a bullish. And the second thing we can see, so where we have the top this one OA buildup. So we can see 44,000 put option, we have 2 lakh contract open, but in the call option I didn't find any 2 lakh. Okay, it means that where the weightage is there, put side weightage. So put side the people are selling more, hoping the market will rally in the next week. So first, so here the PCR is confirming. Second thing, the OA build is confirming the trend. Okay, so now comes the maximum pain. Okay, maximum pain is where the sellers are expecting that particular day or that particular week the option price, most of the premium they can capitalize. By that way the buyers will lose and they will make huge amount of profit. So that is the maximum pain. So here, so first we have seen the PCR. Second we have seen the max OA buildup. So max OA build is very simple. So where the people sold the huge amount of quantity, there the OA will reflect at the very high quantities. We can see this is a 2 lakhs, followed by there is a 1 lakh in the 43,900. So it means that the people are wanted to sell the put option more. Okay. In the exact opposite side, we can see 44,500. We can see near on vertical 1,78,000. So we have the OA, and followed by there is a 1 lakh 44,600. It means that Monday market will be a consolidation between these two ranges. Okay, the higher OA will fix a range. So we can see 44,000 put side and 44,500. Between this range, market will open in the Monday. So after that, actually within the intraday portions, the trend will be decided by intraday traders. Okay. Okay, see here. Okay, straddle. We have seen the straddle. So the call and the put. Okay, if you're buying the both the call and put, that's the buy straddle. If you're just selling the call and put, that's the sell straddle. So we can see the call premium and the put premium. When it is collectively when you combine this one, we can see that the straddle premium. Okay, see here. the 44,400 strike price. So call option trading at 247. So put option trading at 203, right? We have to add both the call and put. Okay. So now we can add both call and put. So 247 plus 203. So how much? There's a 450. So 450 is our straddle premium. Okay. So whenever we are entering the call buy or put buy, or you're taking the strategies, or you just whatever we are doing it, we have to just know, okay, what is the straddle premium and what is the PCR and what is the open interest. Okay, see here. So when you know the combined premium, okay, that's a 450, right? So in the case, the price is 450. Okay, usually what the seller will do when the market opens, okay, by 9:30 they will just enter the trade. Option sellers, I am saying from the point of option sellers, not from the point of option buyers. Okay, because all the trend are set by the option sellers, because they are selling the huge amount of options, they are giving the liquidity to the market. Okay, they are much more important than the option buyers. Why? Because only the option sellers are making money in the market, not option buyers. Option buyers are making money in the market. Okay, that's on 10% time, but at huge amount of profit. Okay, 90% option sellers and 10% option buyers. The 10% option buyers are making money in the intradays, and for the carry forward. Sometimes they are making money in the carry forward, but option buyer, they are making money, huge amount of money in the option in the intraday trading only. Okay, so from the option seller point of view, so we are seeing it now. Okay, so here first we are seeing the PCR, second is the open interest buildup, and third we are seeing the straddle. In the straddle, we have to know the straddle premium. Okay, so when we know these three all only, then we can take the trade. Okay, either the option buy or the option sell. Okay, so for the first I discuss with the option seller. Okay, then I'll go to the option buyer's point, how we can make money as in the vertical option buyer. Okay, so first how we can make the money in the option selling. Okay, so we know the PCR and the vertical the build up. There's the OI build up and the straddle price. So next comes the straddle breakout. Okay, up to this is clear. Because these are the very important topics. Actually, these are very premium topics. The people are charging the huge amount of price for this topic. But with the LS Blue, we are giving all the topics that is completely free. Okay, see here there's a straddle breakout. So when you combine the call premium plus the put premium, so that is a straddle premium. Okay, we are seeing the ATM, right? So I'm discussing only the ATM now. Okay, ATM, when I just add it up, so we get the straddle premium, right? So suppose if the market opens, okay, around say about 44,400. See here, 44,400. Okay, we know our straddle premium is 450. Okay, so what we have to do, right? We have to just from this strike price, we have to add the 450. See here, 44,400 plus the straddle premium 450. So that's come 44,850. Okay, it means that up to 44,850, sellers won't make any loss because they will make money, right? If the market is sideways, or if it is a little bit bullish or the little bit bearish, in this three case, option sellers will make money. Okay, so we have to know the top side, that is a breakout range is 44,850 on the top range. Suppose if the market falls, okay, so we have to know at what particular point the option sellers will hold the market. Okay, The for that one, the 44,400 minus 450, the straddle price. Okay, it comes 43,950. Okay, so it means that that particular day, suppose if the Monday market is getting open, so just calculate these two price. Okay, just find the call price and the put price of ATM, then we get the straddle price. Okay, that particular what you call ATM, okay, plus the straddle premium, then minus the straddle premium, we get one range. Okay, so that particular range we can keep it for intraday. Okay, in the particular range, okay, the option ATM sellers will make money within this range. If the day stays right, suppose if the market moves to 44,500, or if the market fall up to 44,200 also, the option sellers anyway they are going to make money. Why? The option premium will erode very fast because of theta decay. Okay, option sellers will make money anyway in the market. If it is moves higher, or if it is moves lower, or if it stays sideways, they will make money up to this range, up to the ATM straddle range. Okay, you see here. So the call premium plus the put premium is the straddle premium. Okay, second is the total straddle premium. When that is crossed the VWAP straddle premium, okay, then we can expect a straddle breakout. Okay, Mr. Nandakumar, Mr. Nandakumar asked us why 450 minus. No. Actually, we are just deciding the range. Okay, range for the market. Suppose we can see the Monday market opens. Okay, by about 9:30, we know what is the straddle price, right? So see here, suppose if the Bank Nifty is opening at, see here. So this is the Bank Nifty price. Last traded price is 44,436. It means that our straddle is 44,400, right? So just we have to see the call price. Okay. So here 44,400 is the ATM. Okay. So 44,400 the call price. What is the call price? Okay, 247. Okay, and 44,400 then put option. How much it is? 203. Just sum the 247 plus 203. So that's come 450. So what we have to do? So just we have to 44,400 plus 450. Okay. So that's the top range. Okay. So that comes, what is the 44,850, right? Then we have to find out the bottom range. So 44,400 minus 450. Okay, how much it is coming? 44,400 minus 450. I think 43,950, right? 43,950. So these are the top and bottom range for that particular day. 44,850 and 43,950. Okay, these are the two range. Up to this range, the market either if it is go up or if it is go down within this range, the sellers will make money. Okay, it's clear. Only when the range breaks, okay, we can see there is a straddle break. When the straddle breaks, we can see the huge amount of short covering rally. So that we call it as a gamma blast. Okay. So we can see the ITM breakout always first. We can see that in the money, say for example, the 44,400. Okay. We can see this is the ATM. So we have so many strike prices. All are straddle prices. All are straddle only, right? So people can short this also. The people can sell 44,200 also. Some people they can sell 44,000 also. Okay. Suppose if you are selling 44,400, it means that we are thinking market will be in a sideways between the range. Okay. Suppose for example, if you are thinking the market will rally high, Say for example, you are thinking that the market will go 44,000. Okay. Suppose if there is a what you call institute, so they want to take positions. They are thinking the market will go to 44,000. Okay, what they will do, they instead of shorting 44,400, they will sell 45,000 straddle. They will sell this call option and this put option, because when the market from the 44,400, if it stays on 45,000, they will collect huge amount of premium. Understood? They can sell 44 in the bottom also. They can sell 44,000. They can any call and put same strike price. If they're selling it, that's the straddle. So they can sell at the top range also. They can sell it at bottom range also. They can sell ATM also. If they are selling ATM, it means that they are thinking the market will move in sideways. If they're selling in the top, they are thinking that market will rally, bullish sentiment. They are keeping the bullish sentiment. If the shorting 500 points or about 100 points below in the strike price, they think that market will fall. Okay, straddle also having the bias. It will be a bullish bias, or we have the bearish bias also. Okay. So see here, the 44,400 we have the straddle. Okay. As a option sellers, okay, mostly what they will do, by about 9:30, they will sell the 44,400. Okay. Only on the straddle breakout, they will exit the positions. Okay. First point. Second point, about 50% of option sellers, they will exit on 70% of the breakout move. It means that we know the 450 is the price. Okay. So we know the 450 is price. 450 into 75 divided by 100. So that's come 337. So mostly around 350 range, they will exit the positions. Understood? We can see the straddle price, we see 450, but most of the people, if the bank nifty rallies 350 point either on top or bottom, they will start exiting the positions, or they will do a rollover, or they will do adjustments. Understood? Okay. So next comes, this is my one of the favorite strategy. So that's called a triple straddle. Okay. So what is a triple straddle? See here. So 44,400. If the Monday morning open, same exactly on the same price, 44,400. So triple straddle, what they would, so suppose if the option sellers, what they will do, they will sell this 44,400. Okay. But most of the safe traders, most of the HNIs, what they will do, right? Instead of selling only one straddle, they will sell multiple straddles. They will sell 44,300, 200, 100, 44,000, and top also 500, 600, 700, complete straddle box. Okay, they will sell the complete 500 point range. They will sell the straddle box. But as for retailer, how we can make money? We can do the triple straddle model. Okay, so what is a triple straddle? Sell it one ATM. Okay, sell one, what do you call, the 44, that's the ITM, and we can see the further away this one strike price away, there's a 45,000 one strike. We can sell three straddles. Okay, first we have to sell the ATM straddle and the in the money straddle in the call option 44,000 and the out of the money straddle 45,000. So when we are building up this one, we are just expanding our range. Intraday we can see when you're just building up the triple straddle, this is a hedging, right? There is no need of hedging, but for the premium sake, what we have to do, we have to just buy very far, say for example, 42,000 we have to buy the same amount of quantity we have shorted. So by this way, we can take what? We can just increase our lots. Okay, instead of going for a one lot, okay, we can just keep on increasing our lot by doing hedgings. Okay. Mostly I'm doing with the hedging. What I will do, right? I just go for the 2000 away strike price. So buy for 3 quantity and sell it 1, 2, 3. Again, just buy it here. Okay. And sell it 1, 2, 3. Okay. So what is the edge in this one, right? What is the edge in this one? Because when you're selling only one straddle, okay, within about 200 point, 300 point, we have to roll over, we have to do adjustment, or we have to exit our positions. But when you're doing triple straddle, we have more edge, we have more time, because we know our range is very high, 44,400 and 44,045. It means that when you're taking only one straddle, it means that market, we are predicting the market should be in sideways. Okay. What we are predicting? We are predicting the market should be in sideways. But if you are selling one OTM, okay, one ITM, we are doing the same sideways, but with the expanded range. How? Because say for example, instead of selling 44,000, if you are selling only one straddle 44,000 means, so what I told earlier, our view is bearish. Suppose if you are selling only 45,000, okay, it means that our trend, what we are fixing, what we are thinking, our trend should be bullish. But when you are telling, when you are selling the same 44,000, 44,400, 45,000, we just negating this two, because this is bullish, this is bearish, this is bullish, 45,000 bearish, center is sideways. So this bullish and bearish is getting negated, and we are just we keep with the one ATM sideways. So all these three combined, we are getting a big profit. Okay, up to this clear? Okay, Mr. Srijit, this is the intraday strategy. I am talking about intraday strategy, but you can do it for position also. Okay. But for intraday, that is giving a good return, right? Because we don't know what will happen tomorrow. Okay. So what you have to do, you have to do it in the after market open. Okay, just enter this straddle by 9:30, exit by 10 o'clock. That's all. Because we so when you do it, you'll understand how much profit that is giving up, right? Because this is a very good strategy. Just I'm personally following it, but you have to do some lot of research as for the disclosure, right? Because all the strategy carrying a risk, right? So you have to personally just experience the strategy, do some lot of research on the strategy only on because I have said the strategy. This is not the holy grain for all, right? But this is the strategy that's working up. Okay. Okay, it's clear. Yes, we can enter by 9:30 and we can exit by 10 o'clock. But if you want to carry the trade, right, you can carry it to the whole day, right? Because if the market stays below our this one exit range, we can hold it. Suppose for example, we shorted 44,400, okay, and we are shorted 45,000, we are shorted 44,000. Okay, so suppose if the market is not touching the 44,000 levels, till the time we can carry the position. Understood? Because market all of a sudden it go rationally what to 500 point up, 500 point down, within the huge moment it won't give, right? Because see, first you have to understand the trading. The trading is completely a risky business. Okay, all the business carry risk, and the option selling, option buying also having the huge amount of risk. Okay, but how we are managing the risk, that is most important. Say for example, if you have taken the triple straddle, if the market is going down, right, we should know, right, when you have to cover, when you have to do the rollover. The first point kept in mind. Suppose if the market is coming 44,000, okay, what you have to going to do? Just cover the 45,000 strike price and sell 43,500 strike. Is clear? Okay, just repeating the one simple step, simple adjustment. So what you have to do, 44,000, and you have taken 44,000, 44,500, and 45,000 on the high side. So you saw all the three straddles. Okay, there's a triple straddle. So once you build the triple straddle, when the market is traveling downside or upside to your outside post, say for example, you consider this as we can see Indian Army camp. Okay, so they maintain the camp up to 45,000 and 45,000 army camp. Okay, suppose if the enemy is coming here, okay, they want to they want what? They want to shift the post. Okay, what they will do? They just shift it from 45. We can move to 43,500 by means that so they can keep the control. Okay, at the center strikes. Okay, because only on the ATM strikes will the premium will erode very fast. Okay, it means that from the 45, if the market travels to 44,000, we have to keep this strike in there as a center strike. Because triple straddle, center strike premium will just erode faster, but these two strikes will give a uh, uh, they will just expand the range. Okay, because we want to have more edge in the market when compared with other people. For that only we are doing this one. When the market travel to 45,000, exit 45 and just take the shot in a 43,500. So by this case, what we are doing, we are making the 44,000 as a center straddle, ATM straddle. Suppose if the market is again traveling to 43,500, what you do? You have to again repeat this process. Okay. Okay. Here in this strategy, what you have to keep it in mind. Okay. First thing, if the OTM put and OTM calls are sold heavily, don't enter the trade. Okay. See here. See here. So here the 44,000, 45, 4,500, 44,000, 45 shorted. If the market is going down, we have to cover the 45,000 and we have to just re-enter the 43,500. So with that one, we are keeping our center straddle as a OTM. Okay. The logic is we have to keep our center straddle. Okay. As a sorry, this one ATM straddle. ATM our center straddle should be the ATM straddle. Okay. Suppose if the market is again rallying downside, just repeat this process. But we have to keep it in the mind. If the here we are taking the three straddle, that the total is six trades. Okay, three call and three put. Okay, one will be in the money, and one will be the ATM, and third will be the OTM. Okay, out of the money. If the OTM prices are decayed very much, don't enter this trade, because when you're entering at the very lower premium, we in this strike price, in the particular strategy we can make money. Why? Because already premium got eroded very fast. Okay, we can do the triple straddle. Say for example, we can see here we have a 45. Instead of 45, if it is only 4 rupees, we should not enter the trade. Okay, so here the work case is, when it will work on Friday, Monday, then Tuesday, Wednesday and Thursday we have to just leave it to the market, or you have to go for the next weekly expiry. Okay. Understood? Up to this, what you understood? Because we discussed on the what you call PCRs, and we discussed the straddles, and we discussed OA buildup. Because we can see the option Greeks, right? Option Greeks, we have a delta, gamma, and we can see the theta and vega, right? When you just see the price, everything is included in the price. Okay, there is no need to confuse with the option Greeks. Okay, option Greek is everything got included in this one, because some they will say what they will do, they'll make what a delta hedge strategy, right? So when you see the price, delta is nothing but when you see the price, when you see the 35 rupees call, same 35 rupees if you sell, then the delta will hedged automatically, right? So nothing to confuse with the Greeks. So just go as it is like this. Okay. Okay, I can give you the article. The last strategy that we can discuss, that is the gamma blast. After that, we don't have much time. We have only another 5 to 10 minutes. Okay. Okay. Mr. Nandakumar asked for any buying strategy for position for intraday. Okay. The first thing we have to know, we have to carry the positions only on the news base, right? So when there is a news in the market, then only we have to take the option buys. Okay. Without that one, option buy works only in the what? Only in the intraday, and for the we can see the 4 weekly. There's the monthly expiries. Say for example, if you want to carry a trade, don't carry on weekly. So just carry in the monthly. Understood? And should be right. Suppose if you are taking the position option buying, okay, when you want to carry monthly, so just we have to see the daily and the monthly chart only on the breakouts, right? We can say there is a candle breakout, then you can carry the position, because option buy for a smaller capital they'll give a good return, but for option selling we need a higher capital to make a decent money. Understood? So for option buying, okay, I will share one strategy. So that is the gamma blast 350. Okay. Okay, see here, there's a gamma blast 350. It's so simple. It means that in the intraday moment, we have to wait for a 350 rupees movement in the bank nifty. This works for bank nifty. So when the bank nifty is doing same in the, we have to compare the price with the nifty. Okay. Because I'm doing personally for the bank nifty. So that way the strategy name is gamma blast 350. Okay. So it means that in the bank nifty, in a particular day, from the high to low, okay, from the high to low, bank nifty has to move from the top to bottom, okay, 350, or the bottom to top, okay, the combined price, there is a 350. Say for example, market has gap up open and started coming down. Okay, I'll show in the chart. Just a minute. Okay, this is my MT4 chart. We can see. Okay, see here on August 30th. Okay, August 30th, what happened? Market has gap up open. Okay, after that, the market made on high. After that, market started coming down. So this is the gamma blast day. Understood? Why? Just take the high and just go for 350 rupees. See here, this is the 350 range. So just I'm marking it. So this is the 350 range. From there, what happened? There is a 3 candle that given another 300 rupees. Understood? So 350 is the point for the bank nifty, because most of the straddles on the weekly and for daily, they once they reach 350, they will exit the portion. That's why the name is 350. So we have to market 350 rupees. If the market is not moving from the top to bottom 350 or from bottom to top 350, we should not take position. Yesterday also gamma blast. Okay, we can see the gamma blast from here. So market 350. This is a 400. So this is a 350 range. Okay, 350 range. So we can see from 100, how many point it is given? Another 400 point. Understood? Very simple. So gamma is a name that's come from the option Greeks. Okay. Because once the gamma started increasing, the delta of the option Greek will just increase very rapidly and give a very shoot up. At the time, most of the people, they will do the short covering because they sold in the market, because the people option sellers, they can hold up to 350 range. Understood? Because I shown the what do you call the triple straddle also. In the triple straddle also, the people want to do the rollover. Understood? This is the, just a minute. This is what you call a triple straddle. So this also holds. Suppose if the market, the persons say they're taken by what 9:30. Okay. So they are not exited by 10 o'clock. They are waiting for the huge profit up to 1 o'clock. Okay. Suddenly the market moves 350 points. What they can do, they have to either roll over or they have to exit the position. So this is the what you call this is about the triple straddle, right? Because the triple straddle is the most safest in the straddle, but even the triple straddle we have to exit. But when you go for a naked straddle, naked selling without hedging, so what is their case? Anyway, they have to cover at the market price. At that time only we have the gamma blast. Okay. Understood? So that's why this called gamma blast 350. So whenever the market rally 350, okay, see here, whenever market rally 350, so just take buy. This is for option buyers, not for option sellers. Okay, option sellers, what they have to do, they have to go short below this price. Say for example, if there's a breakout here, just go sell on vertical. Put option sell on 43, 900. Okay, we can take 43,900 sell, or you can take 44,000. This candle low also, we can short the put option. For option buyers, what they have to do? They have to buy the ATM price on this price, because after this, the gamma blast will go exponentially and give a huge return in the option buy. So we can see in the what happened in the particular time in the just a minute. So 44,000, the call option. Okay, see here. Okay, this kind of there is a continuous rally on the one side, right? So that give a so that is a gamma blast, because nobody can vertical stop the particular strikes, because it will just keep on this the price will just keep on moving higher and higher, because today they're doing some markup, so chart is not showing correctly. Just a minute. Okay, so here, so the gamma blast come, that's the 350. Okay, we have to see the 350 movement from the bottom to top or the top to bottom. So this, if it is a the top, okay, this is from the top to bottom, so 350 range, or from the bottom to top, the 350 range. Or for option seller, what they do, we have to short it at the low of the candle or at the low of the particular day. Okay, then you can carry for the entire day. Okay, for option buyers, we have to take the ATM buy call here. Say for example, the 44,000, 170, 182, we have a breakout. So buy 44,100 ATM strike. Okay. Okay, it's clear. So we have further more strategy. There is a badman strategy and the calendar spread. So we will discuss in the next week. Okay. So next week we have the one more webinar. So we can have so many topics covered in the same day, because we have the time is only 1 hour limited. So we have another 1 more minute. I hope everyone got understood this one, because there is one more webinar in the 11 o'clock session. So we have to wind up the session as fast as possible. So up to this, any doubt? Okay, thank you for everyone for joining this session. So this because we have to just wind up session very fast, because there are some more person waiting at 11 o'clock. Okay, thank you for joining it. So we'll see it in the next webinar. Okay. Okay, my name is Kumareshan. There's the Babaji Kumareshan. So my phone number 989408855. My website is babajirobotrade.com. Okay, thank you all. I hope the session is useful for everyone. Everyone got benefit from this session. Okay, thank you everyone. Thank you.